Hello, chart watchers, and welcome to this Tuesday, August 21st Market Watchers live show with your host, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, let's take a look and see what's going on in the market today. We got the Dow Jones Industrial Average currently up 105 points, the S&P 500 up 13, getting very close to that January high. We'll talk about that in a bit. The NASDAQ up 62 points, approaching 7,900. And look at the Russell 2000 up 19 points, breaking to an all-time high. The 10-year Treasury yield currently up 2 basis points to 2.85%. Volatility continues to drift lower, back down into the low 12s. Energy leading this push to the upside, back up to 74. Broke down last week, so it's going to be interesting to see whether or not we can get back through the moving averages on the XLE. XLY, consumer discretionary, also breaking out to an all-time high, while consumer staples, the discretionary counterpart, pulling back after leading consumer discretionary for a while. We're seeing that reverse a bit here over the past couple of days. Medtronics reported, talked about this stock in the past, looking very bullish. Well, they just got some great earnings news, and MDT up very nicely, up about 4.6% today. Home builders, we've been wondering when they might come back. Well, today could be the start of it. Toll Brothers blew out their earnings estimates. I also saw DHI performing pretty well as well. And so a number of the home builders moving higher. And I'll take a look at that longer-term chart because the DJUSHB getting very close to a key breakout after trending lower for several months. That would certainly help the discretionary space. Okay, well, Erin, it's been a couple weeks for me since I've been back here in just south of Charlotte, North Carolina. And I got to tell you, I was happy to feel that humidity when I got off the plane yesterday.
I have to say, when I got off the plane too in Southern Cal, I was like, oh my gosh, it's warm. That was a cold cruise. It was cold the entire time for me. And of course, I didn't pack properly. I had like no sweaters. I packed about 8 pairs of shorts and 2 pairs of jeans. So
Yeah, it was definitely very chilly. It was a beautiful cruise, though. I would highly recommend anybody who's interested in going on the Alaskan cruise. It was spectacular, magnificent. So I can't thank the folks at Stock Charts enough for having us out there for that. But I got to tell you, when I got back into Seattle, my flight got delayed going into Dallas for a connection, so I ended up having to fly back a day later. So that's why I wasn't around yesterday. But late in the day on Sunday in Seattle, the smoke from, I guess, the fires in eastern Washington or maybe from up in Canada, I'm not sure which, but it blew into Seattle, and Seattle was just a smoke-filled mess on Sunday. I walked outside and I literally could taste the smoke just walking around. It was
wow,
not,
I felt right at home.
yeah, you would have felt perfect right there Sunday afternoon in Seattle, but I know you were heading. But anyway, we got a lot to go over. I could talk about ChartCon and all the stuff we did quite a bit, but I know we got a lot of stuff to catch up on. It's been a little while, so I'm going to let you take it away.
All right, let's get this started. Upcoming schedule. Okay, so we have Bill Shelby coming in on Thursday. I'm sure he'll have something interesting to tell us all about. Greg Schnell is coming in for Everything Stock Charts. Makes sense. Since he wrote the Stock Charts for Dummies book, I'm sure he'll have some great stuff for us. Julius is going to be in August 30th and 31st while you are gone. Where are you going, Tom?
My daughter is getting married September 1st.
Of course. Of course. Gosh, it's already here. All right. So today's agenda, I'm going to start off with, after the technical headlines, I'm going to do my workshop on my favorite scans. So I was going to run through a few of them and, well, you'll see if you stick around. 10 and 10 to 1, our first symbol is going to be Southwest Airlines, LUV. And we will finish up with a segment on sector rotation. And that's all we've got right now. So let's go ahead and get started. Tom, what are our headlines?
All right. Well, there was no economic news out today, and I don't think there was anything out yesterday either. So the market, the Treasury market, kind of trading on its own. You can see we've been consolidating. It's a long-term weekly chart. A lot of times I start off with a daily chart. But because we really haven't had much news, I just want to kind of bring things in perspective from a longer-term perspective. We saw the drift down back in the first half, maybe first 8-9 months of 2017 after a huge move up into the end of 2016. And you can see that the PPO just slowly drifted and worked its way back to the center line before we broke out and started moving higher. Seems like maybe to a lesser extent, that's what we've been doing. We had a huge push up from the end of 2017 on the 10-year Treasury yield from about 230 up to almost 3% by February. And even though we did spike one more time in May to push up to that 3.11% level, seems like really the last 6 or 7 months just been a lot of consolidation. I think these lows, we need to watch these to make sure we hold around 272, 273. I suppose maybe in a worst case scenario, the breakout level here, which occurred back in January 2018 around 2.60%, could be tested. But again, I think that's probably a worst case scenario. But for whatever reason, we are drifting lower in the yield, and that suggests that there is still a little bit of defensive money out there rotating into the Treasury market. So it's definitely worth keeping an eye on. If we break down the Treasury yield, that would start to argue against a stronger economy down the road, because interest rates should be moving higher if economic conditions are improving. But let's take a look at some of the impacts of things that have taken place here over the past week to 10 days while we have been out. The UUP, the dollar, you can see making a big breakout after consolidating for a while. We broke out, saw some headlines talking about how the dollar's been really weak over the last 3 or 4 days. But the dollar is like, an index or an ETF or a stock, whatever. When you break out, a lot of times you pull back and you test the area of the breakout. And I think that's what we're doing here with the dollar. If we move over to the 10-year Treasury yield compared to what's going on in Germany, you see that this rate continues to move higher. The difference in the 10-year Treasury yields between U.S. and Germany continues to move up. And I've gone over this chart before, but for those maybe who haven't seen it, I think it's worth noting that typically what we see when U.S. rates are moving up faster than Germany's is we normally see a strengthening dollar. It used to be that if the U.S. rose, if rates were rising in the U.S., the dollar would rise. But because we're such a global environment now and we deal with, there's so many inner workings globally, internationally, that it's really important to see what rates in the U.S. are doing relative to the rates in foreign countries. I like to follow what's going on in the U.S. versus Germany. And I think this chart kind of bears me out here. As this ratio moves up, or not really a ratio, the difference between these Treasury yields move higher, typically we see the dollar move higher. And down here, the correlation, I think, proves this out, that we do tend to see mostly a positive correlation between the direction of U.S. Treasury yields minus German Treasury yields and the direction of the U.S. dollar. That's what this positive correlation means. When you get a negative correlation or an inverse correlation, we've seen 3 pretty significant ones over the last decade. And you can see they're highlighted in this red shaded area where Treasury yields are going higher faster in the U.S. than they are in Germany. And each of those 3 shaded areas shows the dollar going in the opposite direction. And that's why we had that inverse correlation. But in each instance, or at least the last 2 instances, we've seen huge rallies in the dollar coming out of those red shaded areas. And then we got back on track. So in other words, if the yields are going up higher or going up faster in the U.S. than in Germany, we should expect the dollar to be moving up and this correlation to be positive. And that is what we've now moved into. We just recently broke above 95 on the dollar index. I think that's a positive, bullish sign for the dollar, even though we've pulled back the last few days. You can see now that that positive correlation back near 1. And when that happens, we typically see the Russell 2000 outperforming the S&P 500. As the dollar's rising, that cuts into the earnings for S&P 500 companies, whereas the domestic companies here in the U.S. That are part of the Russell 2000 don't have to worry about translating those gains in foreign countries back into the U.S. using that stronger dollar. So it's not unusual to see the Russell 2000 outperform. I believe we're going to take out this double top on a relative basis. We've already started to see the Russell 2000 begin to outperform. And as I mentioned at the top of the show, the Russell 2000 is breaking out today to an all-time high, assuming we hold it into the close. Look at this move today. This is an ascending triangle. We've got equal highs coming across, higher lows, and we're getting a break out of that. This measures initially up to about 1800, 1707 down to about 1620-ish, 1625 maybe. You take that difference and then you tack it on, it's going to be up close to 1800. So I'm looking for the Russell 2000 to make a big move here, and that should lead to some outperformance relative to the S&P 500. The S&P, on the other hand, I think could struggle on a relative basis for a couple reasons. We're getting a nice move here, but you can see right now we're at 2870.76. If I stretch this chart out a little bit, we'll just look at 1 year and 6 months. And I posted this in my blog earlier today. I think what we have is potentially an ascending triangle like the one we just saw in the Russell 2000. We'll have to see how it develops, but we've got essentially a test of the January high. I believe that was 2873, 2872 and change maybe. That was the high close that we saw back in January, and here we are at 2870. Seeing how the dollar has broken out, pulled back, tested support, I think the dollar goes higher, and then this would be an area where we could see the S&P 500 pull back. I think there's two levels. If it does pull back, I'd be watching. Actually, I'm going to say three levels. The first level would be the rising 20-day moving average, which is currently 28.35. We've seen some tests there, and we've been holding recently. So that would be a short-term test. I think going back further, though, you can see multiple support areas here at 2,800. Notice the prior resistance was 2,800. So I think that would be maybe a little bit more likely if the S&P fails here, that maybe we'd get about a 2-3% pullback to 2,800. I think in a worst case scenario, with the if the market goes through its typical swoon that we see sometimes in September, then I think if 2,800 weren't to hold, I would be looking back at these other lows closer to 2,700. We would still be following an uptrend with a high, a pullback. This would be point A in an ascending triangle. This is point B. All the way back up here testing this prior high would be C. And the pullback, even if we were to go back to 2,700, I think would be a very bullish point D in an ascending triangle. And then I'd be looking for a big rally into year end. I still think the market goes a lot higher. I just simply think the Russell 2000 is going to outperform. And so a lot of the dollar discussion that I've had here is the primary reason why. Okay, let's take a look at, well, if the dollar's going higher, if it bounces, then I think you got to be very careful with gold. I'm not a gold fan, haven't been for a long time. You can look at the daily chart and see gold has just been underperforming wildly. Even as we were breaking to new lows in early August, we had a positive divergence, but we still never were able to clear that 20-day moving average. And then last week on heavy volume, you can see a lot of selling that took place in gold, and the PPO moved to a new low. So I see a lot of negative momentum, bearish momentum in gold, and I think that is that makes sense given the fact that it looks like the dollar wants to go higher. So I think this is one that we got to be careful of. Another thing, and I know Greg Schnell touched on this a little bit yesterday, or at least I think he did, so I don't want to spend too much time here. But if you're looking at investing in something like the DAX, the German DAX, or stocks in Europe, or maybe the ETF that tracks the DAX, here's a problem and something you need to be thinking about. I'm going to stretch this out a little bit. Let's go back a year and 6 months. And so here is the actual DAX, and you can see a lot of sideways consolidation. But I'm also going to pull up, we don't need the RSI, so let me go ahead and put in the EWG, which is the ETF that tracks German shares. It's the iShares that tracks Germany. And let's, we'll leave it there. I just want to make it so that the size of the chart's similar. And then let's pull up the dollar index, because I want you to see what impact this can have if you do trade these international ETFs with a rising dollar environment. Okay, so at the top again, we have the DAX. So this is what the DAX has been doing, mostly sideways consolidation. Notice that these two lows are about equal on the German DAX, but notice the EWG, if you were trying to track that performance, notice how it's much lower. And look at these lows over here. We're way above. The German index is way above the lows back in March. But the EWG, which is designed to track the German shares, is much lower. So what gives? Well, what gives is the dollar rising. Keep in mind that there's a dollar impact in trading these ETFs that are designed to track foreign markets. So even though the German index is up from this late March low quite a bit, the EWG is down, and the reason is because of the stronger dollar. So if the dollar does continue strengthening, this is an area that you really need to pay attention to as well. These international ETFs can, you can sit back, scratch your head, and wonder why they're not tracking the indices that they're designed to follow. And the dollar, the impact of the dollar is one of the reasons why. All right, let's keep moving because it's been so much been going on. The XLY, consumer discretionary, sideways consolidation. Look at the breakout today on the XLY. What is leading? Well, certainly retail has been doing very well. And you can see retail making another breakout. First of all, we broke out above this double top at about 51, went back, hit the rising 20-day moving average, and we are just flying off of that with the PPO continuing to strengthen. Retail stocks look really good. And then I mentioned earlier, home builders, Toll Brothers came out with a great report, blew away estimates. And you might look at this and say, well, yeah, we're still in a downtrend, and I wouldn't disagree with you. But I do think it's important to watch on the longer term weekly chart because I think we have been in an uptrend. I've talked about this a while. I wouldn't be interested in home construction while we're downtrending below that 20-week moving average. But if we were to break out this week and close back above the 20, I think this could be a signal that maybe all of the selling that we were looking at is over. I thought maybe we would get back down to about this breakout level around 720. We got maybe down to 730s to around 740. We could be turning back up again here. And I think there's a lot of room to the upside in home construction if, in fact, we are bottoming. How about transports? Transport's been looking pretty good. The Dow Jones Transportation Average, look at the breakout here. This is another one. I could pull up the weekly chart, and you'll see we are making a breakout above that January high. If we fail this week with a false breakout, I would treat this maybe as a cup. Maybe we'll get one pullback to hit that rising 20-week moving average. That could coincide with September weakness that I was talking about on the S&P 500. So this will be interesting to watch to see how it plays out. A couple of stocks that came in with earnings that I haven't spoken about. One is COTY, Cody. This is in the personal product space. And if I pull up my relative chart, the stock had been downtrending. And if you look at it relative to its peers, it has been an awful performer. So when you see this kind of reaction to earnings, you shouldn't be shocked. The company was kind of warning and telling us that it was going to be a little bit of a problem as we went into earnings, and it certainly is. Kohl's, on the other hand, I think with the gap down earlier today, provided an opportunity. Kohl's, you can see, beautiful looking chart, nice move up. I don't know, you could consider this maybe an inverse head and shoulders, maybe a cup. Either way, we've gone down, we've tested the rising 20-day. And after gapping down earlier today and testing the 20-day, it looks like we're ready to break out. Look at the volume coming in. This is a group that's very strong, the apparel retailers. And Kohl's, relative to its peers, has been doing okay, hanging in there. I would expect to see Kohl's making this breakout. Upgrades and downgrades. I'm going to stick with this relative chart. I just wanted to point out a couple of individual stocks that were upgraded. VTL, Vital Therapies. This is in the biotech space. Beautiful breakout. This stock's been performing extremely well while the biotechs are nowhere near their high. And as a result, this is one of the stocks leading on a relative basis. DISCA, this was Erin's pick in her Monday setup yesterday. From what I understand, great pick. Stock up about 4.4%, making a breakout here. Recently, it had broken out while the overall group broadcasting had not. Look at the relative strength prior to today's upgrade. So I think the stock looks good. SYMC. This is Symantec. And here's another one. This one had been in a steady downtrend, even though software had been going higher. So look at the relative strength. You do not want to be in stocks that have weak relative strength, in my opinion. I think if you're bottom fishing and looking for stocks that are being cast aside, it can be a long time before they reverse, if they reverse. So I'd be careful. That could be an exhaustive gap. Maybe we're beginning to uptrend, but this one's got a lot of work to do on its chart. I'd be careful. FND, I think this one also was in a downtrend. Yeah, big move down here earlier, continues to drift lower. And even though we gapped up with its upgrade today, you can see on a relative strength basis, this thing had broken to a new relative low. This is relative to the home improvements group, not one of the better performers in this group. Let's see, Estee Lauder, EL, upgraded. And the stock had moved up yesterday, went all the way back down and filled a gap. I think this one will be interesting because it's at its 20-day moving average and gap support. I think the reward to risk in EL looks pretty good. Finally, WDAY, which is Workday. Look at this triple top breakout just recently. Solid volume, gets the upgrade today. It's been performing very well over the last month here on a relative basis to its peers. This is one that with the breakout heavy volume come in, looks like it wants to go higher. So I'm going to go ahead and wrap that up now with technical news. I know there was a lot in there I was trying to get covered, but Erin's got a solid workshop for you, and I'm going to let her take it away and go over her favorite scans.
All right. Yes, I was trying to figure out what I wanted to do today, and everybody always asks us about our scans, and so I decided that what I wanted to do was, go over my favorites, and of course I will print all of the ones that I'm going through in the Market Watchers Live recap. So I'm going to set it up so that you can copy and paste them and then just wham, put them right into the scanning workbench so that you can use them and, change them around the way you like them. So let's go ahead and get started. I'm going to go ahead and I'm going to show you just where you can find the scanning on the member homepage. Then we'll look briefly at the scanning workbench just so you can see in general what that looks like. I'm going to go over my general PMO scan, and then I'm going to show you how I focus it. So when I want to change up a few things, I'm going to show you my bottom feeder scan. And then finally, I'm going to finish with what I call my scan for dogs. And that's where I look for, I'm looking for shorting opportunities when I use that scan. So in all honesty, I don't use it very often because, we've been in a bull market that now they're saying is probably the longest in history. Did you read that, Tom? Something like that. So I haven't been using it, but I'm going to show it to you because I know some people, you do like to do buying and shorting. So that's how we'll work that out. And then I'm going to show you how I adjust the predefined scans. They're already out there, but you can use pieces of the scans from, your favorite ones, the ones I'm going to show you, or whatever others you have. You can just copy and paste and just add those different criteria to the predefined scans. So I'm going to show you how to do that as well. So let's go ahead and get started with just looking at the member homepage and where you can get the scanning. So the first thing I want to mention, of course, is that you need to make sure that if you want them on your dashboard, you need to make sure this box is checked right there. So, okay. So I just unclicked it, but I want it back on. And that way you'll get the panel for scans. And of course you can click here and it'll take you right down there quicker. Okay, so like I said, I have a couple of scans I'm going to share with you. But first I wanted to go ahead and just show you this is where you can get those scans on the member homepage. You can create a new one by clicking here or by clicking here. And then of course, this is where you can get to those predefined scans. So if you were to just click to start new, to get a new scan, that's going to bring us to that scanning workbench. And it already sets up one set of criteria right there for you. And that is that it is a stock and that the simple moving average, the 20-day simple moving average of the daily volume is greater than 40,000. That may or may not fit your criteria. So, you could certainly adjust it if you want something with a little bit higher volume. Maybe you want to have it a 50-day instead of a 20-day, however you would want to do that. So the scanning workbench itself, this is where you would, of course, add the different components. And there are so many different ways to do this. One of the ones that I don't show very often is, how to scan a particular chart list. Because, you may have your special chart list, your watch list, or whatever it is, and you don't really want to scan everything. You just want to scan on that list. And Tom, I'm sure, probably uses this when he does scans on his strong earnings chart list. So you can just pick any of these that you might want to use. And I'm going to use, let's use my watch list. So I could add that in here. And now it's just going to scan those that are on my watch list. and are a stock. And, I don't need all of that. If I'm scanning off my watch list, I know exactly what is on it and what I would want. So I don't even need to put that first part. So that's one way you can add to just scan a particular chart list. You can, of course, add your price and volume. I think these are more well-known. You've got the various properties, like we were saying. You can do it by country, market cap, that sort of thing. The technical indicators, this is where I use the PMO, and you can use the PMO line, which is the actual value of the PMO, and then the PMO signal, that's the signal line that we use, that average. So very easy to add these, but I'm going to show you the ones that I already have them on, because I know, like I said, I can show you how to use the PMO without having to start from scratch. It always helps to go and look at, what our other commentators do, and, make a comparison, and you can grab the pieces you like from other scans and from other bloggers. So I'm going to show you, like I said, my favorites. So I'm going to go ahead and start with my general PMO scan. And this scan I have written about. I have a link to the article at the bottom of all of the Market Watchers Live blog entries. I also have a link to it at the bottom of all of my Decision Point blog articles. You should be able to find this scan very easily by just going to any of the Market Watchers Live recaps or the Decision Point blog entries that I make. You'll find those scans in there to get to that article to give you this particular scan. So what I'm going to talk about here is, first of all, when you put these little hash marks here, that is a comment line. So anything past that is just description. That's just telling you, the way I have it set it up, but it tells you what I'm scanning for. So it gives you the, in comment form, what it is that the code underneath is telling you. So that is one way for you to get a little bit more familiar as well with how, how these work when you copy them. And I highly recommend you use those hash marks and comment quite a bit through your scans. It really helps keep them together, make sure that you've got the right code in there that you want. And then the other great thing about those hashes is that if you decide, maybe you run your scan and you're not getting that many, you're not getting as many entries as you would like, you're not seeing as many results, you can use those little hash marks, and basically you're commenting out that particular code. So for example, I have this one, it sets up, I like to find stocks that have a scooter in what I call the hot zone, greater than 75. Well, maybe I'm going to run the scan and I get, 6 results. Well, I might want to expand my horizons here. And the way I do that is by taking away some of those criteria. And you can do that very simply by just adding those hash marks in front of it. You don't have to erase it from the scan. It's always there for you. And it's a way to run them that way. So let's go through this one slowly, and then I'll show you how you can focus it. So this is, I call it my general scan, because I'm looking at pretty much all US stocks. The only difference is I do have the volume, daily volume moving average. I have it set up at 100,000. And if you recall, when you start a new scan, it automatically sets it up for 40,000. I adjust this back and forth. Again, it depends on what kind of results I'm getting. If I'm just getting too many, stocks where you could really manipulate because the volume is so low, I might change that and make it more like 500,000. But this is just the general scan, and that's how I have that set up. So you've got stock, type of a stock, daily volume greater than 100,000. And then the country is US. So that's in general. Then I want to take the penny stocks out, or the high volatility stocks, because I'm not, I don't care to invest personally in stocks with, that are less than $10. I mean, everybody has their threshold. That's pretty much my threshold. It's just, and even that, even at $10, $12 stock will sometimes make me a little nervous if it looks very volatile. If it moves slowly, then I might consider that. But that's the criteria that I put in to keep those penny stocks out. The next one is I want to have a PMO. And of course, the PMO is my price momentum oscillator, similar to the PPO. So it's measuring the condition of the stock as far as momentum goes. And so I don't want the stock to actually have had its buy signal yet. And I'm going to explain why as we go further down. But I want one that's on the verge. I want one that's just getting ready to have that buy signal, because I want to get in just a little bit early, not too late. And I think it opens up my horizons a little bit more when I'm going in and peeking at what I want. Because a lot of times, if you've already gotten the buy signal, I mean, of course, a lot of the move has happened, but I feel like I can get a little bit of a jump on the move. And I know some people have adjusted the right here, our setup there as far as what the default is to make it a little bit shorter. And you can certainly do that. I'm just used to using it this way. This is the way we developed it. So I use the scan in a way that I see the PMO on my chart, if that makes sense. I think it does. All right, so you have your PMO line. Like I said, that's the actual value of what the PMO is currently. And then it needs to be less than the signal line. So let's just go, and I'm going to just look at a chart. And there is that lovely chart from my Monday setups. But I'm going to do something a little less. Let's just throw in, let's see, this is one that somebody was talking to me about lately. All right, so here's your PMO panel. The red one is the signal line. Of course, that is that moving average. So the actual value is the black line, and the signal line is the red. So what I'm looking for are stocks that have the PMO line, the black one, below the red, because I don't want to have that crossover just yet. So that's what's in that scan that we are just looking at. So let's go back here. Okay. Now the next thing is I want that PMO not to just be below its signal line. You know, I don't want it traveling lower. I want it to have been traveling higher. So this is how I set it up so that I could get a PMO that's been rising for about 3 days. So I look for the PMO line that is today's, and I want it to be greater than yesterday's, and then I want yesterday's to be greater than the one 2 days ago, and I want 2 days ago to be greater than 3 days ago. So that is a rising PMO. So I want a rising PMO, but I want it to have not yet had a crossover. All right. The next thing I look for when I'm looking for a stock to invest in is I want to have the right trend model configuration. Let's go back here to our chart. The DP trend models are based on the 200-day, 50-day, and 20 and 5-day EMAs. So those are the ones I have in mind, and I want to set them up so that they are in the right configuration. I don't really want a 50-day EMA that's below a 200-day EMA. As far as decision point analysis goes, our analysis process, if a 50-day EMA is below its 200, you're looking at a stock, index, ETF, whatever it is, that is in a bear market configuration. I mean, it's been on enough of a slide that, you know, you're seeing, you know, the 50 goes below the 200, and the wider margin you get on that, the worse really that stock is doing in the longer term. So I don't want any stocks where the 50 is below the 200. Conversely, I also don't want any where the 20 is below the 50. So the configuration I'm looking for, and we'll go back here and look at that scan. The configuration I'm looking for is I want a 50 above a 200. Remember, that was the see, purple and dark blue. And then I want the 20 to be above the 50-day EMA. And again, I just am setting up a configuration where we have a stock that has been doing well in the long term, well enough, and we have it in the intermediate term doing well enough. I don't have the short-term trend model in here, and that would be the 5 and 20-day EMAs. But this is my general scan, and typically I'm not looking for short-term investments. I'm looking more towards the intermediate term. So this is why I have that particular configuration set up. All right, and then the final one, like I was telling you earlier, is I want a stock with a scooter that is greater than 75 or in the hot zone. And, you know, a lot of the, and I'm going to be going over a bottom feeder scan. But for me, when I'm getting ready, I am a momentum trader. I'm also a trend trader, like Greg Morris. I want to actually be in something that's already switched its trend. Yes, I may lose out a little bit on the front end, but I feel that my I'm going to do better in the longer run, in the intermediate term, if I get into something that's already kind of shifted its move to the upside, rather than sort of guessing whether it's getting ready to move on to the upside. You know, is it going to hit that support and actually move up? I don't know necessarily until it actually has started that move. And so that's why I set it up with scooters that are greater than 75. Scooter, of course, being the stock chart's technical rank. All right, so that is the general scan. And this is where you can, of course, adjust how many trading days before. If you wanted to just go after, I only want to look at 2 days before the last update, or do I want to look at the last 30 days before? I typically just leave it at 0. And have either the last market close, or I just do the last intraday update. And I feel like I get a pretty good amount of results that way. So let's go ahead. I'm going to run it just so that it'll give you an idea of what we might see. And we ended up with 19, which honestly I think is not very many for that general scan. I usually see a lot more, which tells me that there might be a little bit of issue out there as far as the market. But, you know, we have had a little bit of hiccuping, I'd say, recently. So it's not too much of a surprise. But I have to tell you, in February, March, when we were going through those particularly bad corrections, I was getting no results on these scans. So I think running them regularly also, I think, gives you kind of an idea of what the condition of the market is overall, just based on how many results you end up getting. So I'm going to go ahead and take these, and we're going to put them in my scan dump chart list. This is the ever-moving chart list. It is never, if I want to look at something, I need to move it to another chart list, because I'm immediately going to just replace the list with what's here. So one of the one that's is interesting that I wanted to look at really quick is Darden Restaurants. This one came up on my scan yesterday for Monday setups. I ended up giving that one out. Wasn't my pick, but that did come out. And when we did the summary chart, it turned out Greg also had it on his Monday setups. We hadn't, gone through, oh, well, I have this, and do you have that? So I thought it was interesting that both of us had it. And since it's still showing up on my scan, let's look at why it showed up on my scan. All right, 50 is above the 200, 20 is above the 50. So our trend model was set up the proper way. We have volume that is, the simple moving average for 20 days is more than 100,000. We have a PMO that is below its signal line and has been rising for the past 3 days. It's starting to flatten out right now with the intraday value, but at this point, it's just getting ready for that upside move. And, I'd put it up there because we had just had that breakout above that overhead resistance. And so far, so good. I mean, if you picked it up yesterday on the Monday setup, it is, pulled back, but maybe now is a better opportunity. You've got that scooter in the hot zone above 75. So that's, how you would look at some of these results, and you can see why this ended up as a result to that one scan. All right, so let's go back to our workbench. I'm going to show you what I'll call my focused PMO scan. It's pretty much the same thing. The only difference is I include a universe that is indexes or sector or well, pretty much, yeah, sectors, indexes. Maybe I want to make it just ETFs, but this is where I focus it, is really just over the universe that I'm scanning. The rest is not different. It is the same. The only difference is I don't have the scooter on the focused PMO scan, and I am saying exactly what universe I want to scan. And how do you add your quote unquote universes? Right down here. I want to look at exchange for traded funds. So I can add that in there. It comes into the bottom. That's how it works. So I will put it back up here. All right, so if I left it this way, I would be getting ETFs that were in the 500 and 600. Well, I don't think there are. So I need to make that an or, because it can't be in all three. It can only be to each its own. So that focus, that adds some more focus. Well, what if I want to look at maybe just, let's go to the sectors. Let's see, what if I want to look at just consumer staples? So I can just click it and add. Again, it's going to put it here at the bottom. And I'll just make that my universe right there. Now what I'm guessing, because we're going to run this, is I took what was pretty much that general scan that we just ran where I got 19, and I've just now, made that universe smaller to just the consumer staples sector. So I suspect if I run this, the only difference is that scooter criteria above 75, that's gone. But I'm guessing I'm not going to see very much off this scan. So let's just see what happens if I run it. 6. So now we basically came up with, of those off that general scan, I've now focused it to consumer staples, and I took out the scooter requirement. If I had added the scooter requirement, we still would have gotten 4 of these 6, because we had 4 of these with scooters above 75. So that is one way to adjust the focused PMO scan. So let's go ahead. I'm going to show you my bottom feeder scan. And you'll notice a lot of these are very similar, but of course they are. This is, I have my analysis process. It's not, I don't really mix it up that much. So here we go. So the bottom feeder scan is, again, the universe is pretty much, as I said, stocks with a decent volume in the US, no penny stocks. In this case, I'm looking for the PMO not having a positive crossover. Okay, that's the same. I want it rising for 3 days. That's the same. The difference is my trend model configuration. Since I'm bottom feeding, I'm going to go ahead and have a 50 below the 200-day and a 20 below the 50-day, because these guys have been sitting on the bottom. But the difference is I'm adding that short-term trend model in there to be on a buy signal. I want the 5-day EMA to have crossed above the 20. So if you think about it, you've got a stock that's in decline. Those EMAs have been falling, but now that shorter EMA is starting to make a move and turn up, and it's now above the 20. So now I'm picking out stocks that maybe are in terms of trend shifting upward, but I'm also getting the momentum that I want as well. Now I have the scooter in here. I don't want it to be in the hot zone, because again, I'm bottom fishing. I'm looking for something that has been in having trouble, but I want it to be turning back up. So that's what I'm looking for. Okay. So let me go ahead and let's run this one just to get a quick look. All righty. I added it over here, 54. So we have 54 that might be possible bottom feeding opportunities. So you can save that. And like I said, there's the one that I just replace every single time. And as I generally recommend is going into a candle glance mode. I've saved my own candle glance style. You can do the very same thing. Just save the chart style you want on your candle glance. Just save it as candle glance, and then you're going to get this. So you can see we've got PMOs that are having crossovers that have been rising for the past 3 days that have, you can see the 20 is below the 50 is below the 200. All right, so let's look at, finally, I want to show you my scan for dogs. And this one I have a universe set up, but you can, again, you could just copy from one of the others if you want a more general universe. And in this case, I'm looking for, I basically turned everything upside down as far as the PMO. I want the PMO to be above its signal line. So technically still on a buy signal, but the PMO has started to move lower over the past couple of days. And then I want it to be where the 20 is less than the 50 and the 50 is less than the 200-day EMAs. And again, that's a dog type set up, right? You've got, it's been in a longer term downtrend and an intermediate term downtrend. Scooter less than 75. So that's my way of scanning for dogs. And again, I will put these in the Market Watchers Live recap. Before I finish, though, I do want to show you that you can also, let's say I want to look at, I'm going to go back to my focused scan or my general scan. And I'm going to just take this part right here, the top part, the basically US stocks with decent volume and greater than $10 close. Let's go to our member dash. And I'm going to go down to the scan box and look at a predefined scan. So here's, we have 513 that have just had the new 52-week highs on all exchanges. You can come up here and you can edit that scan. It's already set up for you. So this is telling me what kinds of stocks it's looking for, and that adds, you know, the max, that's where you get the new 52-week high. Well, let's say I want to add on here as well. I don't want stocks that have, let's see, stock add, let's make sure that this, I'm going to take this first half out because it's basically what this part is, only adjust it a little bit. So now I'm able to add what I want in there as well as what has already been done. So when I run this scan, I suspect we're going to get less than 513. Alrighty, where did they go? Oh, see, you should check the syntax. And I'm guessing it's because this needs an and. Yes, the first one doesn't need an and, but the others do. Okay, let's run it and see what we ended up with. So we went from 513 down to 326. So that's one way that you can, you know, use a predefined scan, but add some of what you like into it. So that at this point, I'm gonna cut it off here. I hope this has been helpful for you, and I will have, again, I know people are always very excited about getting other scan code from other people. I like to do that as well. I will have these in the Market Watchers Live recap for August 21st. So you can go in there in the August 21st Market Watchers Live recap, and you can copy and paste all of these scans that I just showed you. So that is really the completion. Now it's time to move on into the 10 and 10. Do you have any favorite scans, Tom, while I get these loaded up here?
Yeah, I mean, I normally scan against my strong earnings chart list, but a lot of times I'll scan using, say, the RSI between 40 and 50, because if you follow stocks a lot of times during their uptrends and you look at their pullbacks, which is more my investing or trading strategy, is to get them when they're weaker in an advance during an uptrend. Usually the RSI is back into that 40 to 50 range when many of these stocks turn and move back up. So I don't buy just because the RSI is at a certain level, but many times it does alert me to the fact that maybe these are some of the stocks I should be considering. So that's one of my favorites. I always, apply a high volume scan, that sort of thing as well. But most of my scans are run against one chart list, my strong earnings chart list.
All right. That gave me just enough time to add the final 10 and 10 requests. Let me go ahead and I'll show everybody what we've got here so far. Okay. All right, so I have about 31 of them. I'm going to pull up the RRG quickly, and we'll look at the daily version. Fit, there we go. Make these tails a little shorter. All right, so interesting. A lot of in the lagging and improving that are way out there off the S&P 500 there. So it'll be interesting to look at some of those probably. We did get a couple of requests that we did look at yesterday. So sorry, but I won't be including those. But let's go ahead and get started right off the bat there with Southwest Airlines.
Okay, on Southwest Airlines, first of all, the airlines, I mentioned at the top of the show, transportation stocks have broken out. Airlines being the weakest of the transportation stocks, but still they have been uptrending. And you can see here with Southwest Airlines, we're also getting a nice uptrend here, along with some solid volume to accompany this to the upside. So I would be looking for a couple of things. I think Southwest Airlines looks good, but I would want to see the rising 20-day moving average hold. Notice that the 20-day moving average currently is very close to a key area of support. So once we went through about 58 and a quarter, we went back and tested that level, and then we broke out again. But we may not go all the way back down to that level at the 20-day. So I've also highlighted the breakout. You can see the selling that took place back in late January when the market went into its little bit of a swoon. The airline stocks took a big hit. You can see that Southwest Airlines, fell, and on its reaction highs, the attempts to move back higher, we haven't been able to get through about 60 and a half until yesterday. Very heavy volume. We closed at 61 and change. So I think that maybe that initial test of support around 60 and a half could hold from a short-term perspective. So these are the two key support levels I'd be watching. And to the upside, I think eventually we're going to see a $66 trade on LUV upcoming.
All right. And the most popular in the chat room is Netflix.
I anticipated Netflix. I already indicated it.
Look at you. Okay.
Yeah, it's in a downtrend. You can see the heavy volume here on the gap down. We've come back up. Notice we have not been able to get through that declining 20-day moving average. I'm still a fan of Netflix, but I don't want to step in front of a freight train that's moving lower at this point. And in particular, if you look at the specialty retailers and compare Netflix to its peers, it has been downtrending now for about 6 weeks. And I do think it's going to eventually turn, but I don't want to try to guess when. Maybe that bullish engulfing candle yesterday on increasing volume was it. But if that's the case, we should see a break above the 20-day moving average. Got a couple of key areas of resistance overhead. When we gap down on that 60 million day share day, that was back on earnings. The reaction back to the upside to 380, we went down to about 340. But notice the prior low was at 380. So all we did is gap down, go back up, and test what was prior support. That becomes resistance. And then we've been working our way lower. Notice that the last high was up near the 20-day moving average and close to 360. So I think I'm going to say 350, 360 area could pose some problems for Netflix. I like Netflix, but I want to see it start to trade more bullishly from a technical perspective. So for now, I'm going to avoid it.
All right. Let's see. The next one, actually, it was requested by one of our VIPs, VOD. Michael wanted to look at the monthly chart.
Okay. Well, I'm not a big monthly chart fan, but I'll pull it up because of the request. And let's see what we got. I think we've got really good support around $22. And if you just go to TA 101, broken price resistance becomes support. You can see that clearly we established a major top in 2007. It was 5 years before we got there again, pulled back for 6 months after that, went back through, and once we broke out above this 22 level, it's been holding on these pullbacks. So from a longer term perspective, I'm not a long-term investor, but from a longer term perspective, I think you're in a trading range between 22 and 32, and we are trading at 23, so I like the reward to risk on the entry here.
Okay. Let's see. Let's make another one. Oh, for our Canadian friends, CM.TO. It's a financial bank.
All right, CM.TO. I like banks, so this one's been a great relative performer as well. I'm going to take it back just a little further because it looks like maybe we made a pretty significant breakout recently. And so, yeah, we got a lot of tops coming in here at about 116, then this top around 117. This was a pretty key reaction high off of a lot of selling. I consider those to be really important resistance levels. And so annotating and looking at the key areas of resistance, that would certainly be one right here. That was also pretty close to the high in June. But after breaking above, we really haven't looked back. PPO still looks good. So I like it at two levels. First, the rising 20-day moving average, and that would be just below this 120 level. Eventually, if we get a negative divergence, perhaps we'll see a little bit more selling down to the 50, but I don't think that's in the cards in the near term. So if we get a couple dollars off, maybe that back closer to 120, maybe just below 120, I think you got a pretty solid short-term entry at that rising 20-day.
All right. The next one is from the energy sector. Also very popular request, Chesapeake Energy, CHK.
All right, Chesapeake. First of all, energy trying to bounce back, but it's been ugly since posting that recent high, and Chesapeake's been going down as well. I thought after gapping up here and pulling back and filling this area back down to about 440 support, I thought Chesapeake was ready to make a move. It has posted a couple of hammers at 440 with these tails down just around 420, and you can see that coincides with some pretty important lows in May and June as well. So I think if I was looking at Chesapeake, I really want to keep an eye on this area of support. That is the low after a huge run up, the low down at about $4.10, maybe just beneath. And then if we come in here and put in a second one, which was the recent low around 420, I think this is a key area of support that we want to see hold. As we move back up, I think the first key area of resistance is going to be up near 490, assuming we close back up above the 20-day moving average. I think this one goes higher, but I would certainly honor the support level 410 to 420.
Okay. The next one is going to be gambling industry, SGMS, Scientific Games.
Yeah, this is one that looked really good for a while on a relative basis. I'm going to pull up the relative chart, but the whole group kind of fell apart, and SGMS certainly is falling apart on its own. But you can see that when it broke out back in May, it did so over the January highs, and the overall group had not broken out. So when you're looking at a relative chart, you can see SGMS was performing really well heading into, say, late May, early June. And then, and I'm guessing maybe we had some sort of a negative divergence. I'll take a look at that in a second. But once we broke below the 20-day, look at the failure at the 20-day, and then the selling really picked back up again, and the volume is not light. This seems like a lot of distribution to me. So on this particular chart, I think you've got major overhead resistance at that triple bottom breakdown at $40. So if we were to move back higher, I don't think we're going back to 40, to be honest. I think probably what we're going to do is maybe get another test of that declining 20-day moving average. If it were to get back to about 35, if I was in it short term, I'd be taking my money and running. I don't even know if it gets to the 20. This isn't my kind of style to trade these oversold bounces. I'd rather get a stock that looks better technically. So I would avoid it. But if you're in it or you're looking for an exit point, I think that falling 20-day moving average would be the level I look at.
Okay. Let's see. The next one will be Fitbit. Mine actually, I think, was ready to explode on the cruise because I never do that many stairs. So anyway, FIT, Fitbit.
All right. Well, no pun intended here, but it looks like it's making some positive steps to the up.
See?
Here we go. Let's take a look. I like the fact that the channel looks to be breaking or looks to have already broken. And a channel can be drawn using the annotation tool by drawing one line to connect either highs or lows, and then using the command and the left clicker, you can actually just take that same slope. It's not exactly, but it's pretty darn close in this downtrend to having exactly equal slope from the highs, connecting the highs and connecting the lows. But I do like this breakout. If there's one negative, I'd like to see a little more volume coming in on this push to the upside. So if we don't get the volume, I think we could struggle if we get back up to about 650. That's where we had a lot of support before the volume breakdown and all this selling. You can see the volume accelerate. So I think as we move higher, I think the big test is going to be at 650.
All right. The next one I have, we haven't looked at U.S. Steel in a while. How about X?
All right. Big breakdown here, big volume on the breakdown at 32. So I think as we move higher, we're going to have some overhead resistance there. So if you're in it on the long side, you really want to clear $32. Here you can see the falling 20-day moving average is right at about 32. Also, that prior low, as we break down on increasing volume, that's going to become resistance. So I think $32 has to be cleared. Stock was at 28 and change, has already moved up about 10% off the lows. I think this move to the upside may be getting a little long in the tooth. Be careful if we don't get through 32.
Okay. The next one is going to be from 8x8 in the fixed telecom industry, EGHT.
Okay, I'm not sure if this was an earnings related candle or breakout candle, I should say, and a breakout or a false breakout, I should say. But that was a pretty ugly bearish engulfing candle. And we came back, tested this gap support level. I'm not even sure that's a really big gap support level, and then started to bounce off of it. But I do think that a key trading range has been established here on the stock. First of all, the gap up that we saw back in July with very heavy volume. That is where all the selling began off of that gap up. So as we get up to 23 and change, I think you're going to see some sellers reappearing. And to the downside, I think we have this recent low on heavy volume. This is where the buyers came back in. So I think we've got a battle here in the near term between, say, 1975 and maybe about 2310, 2315. If we can get through this level and you see the volume pick up, I would view that very bullishly. Otherwise, I think it's range bound for a while.
Okay. And our last one is going to be DocuSign, DOCU.
Okay, DocuSign. Well, it's only got about 4 months history here, so I tend to shy away from companies that don't have a lot of history unless I can find what I think is a major support level. I mean, trend lines really aren't going to work because you just don't have enough trading data. But we do have an uptrend. So what I see here is a stock that has made a nice move to the upside. And let's highlight this, which I think everybody can probably follow along pretty closely. But there's your uptrend. Off of this, we could be here, forming a cup. And the way you can do a cup is by grabbing this parabola, and then you just take the high, put in a mark there, and maybe one of these. Anyway, we'll just go with this one right here. And then as it moves back up here, you can kind of get this rounded formation off of an uptrend. A lot of the volume has come out of the stock too while it's been consolidating, which I think is a good thing. And it's starting to pick up on the right side of the cup, which is normally a good sign. So I think the DocuSign looks pretty good here. Again, I wouldn't trade it because I just don't have enough history. But what you're looking for ultimately is a breakout on heavy volume above 65, which is that you have two opens on these two red candles here at about 65. The second of which you can see volume picked up pretty significantly. So if we could get that breakout above 65, that would be bullish. I think what we may see is a test of 65, a pullback, and maybe that rising 20-day could offer up a nice reward to risk entry.
All right. That is 10 stocks in 10 minutes or so. These are the symbols that Tom annotated today. I will get these up in the Market Watchers Live chart list. And all you have to do is go to the blogs tab, click on the Market Watchers Live blog, and the link will be right there at the top. You'll get all of the charts exactly as Tom annotated them there. All right, looks like it's time for our final market update. So let's go see what the market has been doing. All right, here we go. Markets are up right now. You can see Dow Jones and S&P 500, after pausing just a little bit this morning, are starting to move back up and higher. NASDAQ is also rising, has been in a pretty nice uptrend most of the day. S&P 100 also moving higher, up 7.53 points. We have the S&P 400 also on a really nice run to the upside. And look at the Russell 2000, almost straight up this morning. It is taking a slight pause right now, but it is still looking very, very strong. TSX, big move on the open, is pulled back a lot today, a little bit today. We're getting, it looks like about half the gains have been erased, unfortunately. TNX Treasury yields are up right now, reading 2.848%. UUP, the dollar, gap down and is continuing lower. It had consolidated for a while here, but now it is making another intraday low. What I think was very interesting when I looked at this setup is the fact that, you know, we had gold open just slightly higher, but with that big gap down and the dollar still moving lower, gold was moving lower and actually was on the downside. So I think that shows you that there are some sellers out there. It's not just based on the what the dollar is doing right now. So I think there are more sellers out there on gold in addition, because you have, when you see the dollar move down like this, you would expect almost an equal move in gold to the upside based on the fact that it is counted in dollars. So to see it moving down with the dollar, that does show some extra weakness, I would say, for gold. USO, big gap up, but is pulling back, taking back about half of those profits. VIX is lower and it's continuing to move mostly sideways at this point, but reading at 12.17. I want to take a look really quickly at the climactic indicator chart for decision point, and here's our VIX down here. And though we have very low readings, it's really sitting right in the middle of the Bollinger Bands. So we could see even lower readings before I would look for the markets to be vulnerable to, you know, excessive bullish sentiment. Right now, while it is very bullish, I think it's helping feed some of this move to the upside that we're seeing in the nice breakout. Also notice that our new highs are continuing to rise. We're seeing this breadth movement to the upside here for the new highs, new lows. And I think that that's showing that there is some definitely some support here for the current rise that we're seeing. I will be watching to see what happens on our advances declines, because we are seeing a little bit of a decline here, a little bit of a move lower here on those advance minus declines, and also on the advanced decline volume. So I would be watching that, because if we do see that breadth movement going to the downside, it's not supporting the upside move. But right now, I think we have a lot of participation when you see that you know, we have 61 new highs in the S&P 500. And that closes out our final market update. Did you have anything you would like to add, Tom, before we get into that sector rotation?
Yeah, we talked a little bit earlier about some of the key areas that are doing well, especially home builders and so forth. I did want to also point out that some semiconductors are having a really strong day today, but it's a group that held on to some key support. If you look back at the lows late June, early July, right here at about 33.50. Look at these two dojis where intraday it looked like we were breaking down, and yet we came back up and held. This could be building of inventory in market makers or for market makers, because it did look like a breakdown. And from a short-term trading perspective, I don't like to try to buy these breakdowns. I would normally be, you know, having stops in play and actually selling on these potential breakdowns. I think a lot of traders are the same way. So the fact that we did recover off of that and start to turn back up, and we're following through with some really nice strength today, semiconductors up over 2% on the day. I think that this is a good short-term sign, because if you're looking at technology to potentially lead the market or at least go along with the ride to the upside, you don't want to see semiconductors breaking down. And those lows that we saw yesterday and then again on Friday, those were lows that marked the lowest levels that we had seen in about 3.5 months, dating back to early May. So semiconductors making a big bounce. I thought that was worth noting today for sure. Okay, we are going to move into sector rotation. And I did want to just start off by taking a look at some of the sectors that I had looked at previously. So let me go ahead and get this set up for you. And I'm going to go back into, take a walk down memory lane here. And what you see here was this is an article I wrote back in February when the market was selling off. And I thought maybe the bottom was in. The S&P 500, I talked earlier about how we might be in some sort of an ascending triangle. I wrote about this really back in early February when we had that initial drop where I was looking for some sort of a bullish continuation pattern to develop. And the reason that I was looking for this is that underneath the surface, it didn't look to me like a bear market. It just looked like a correction off of a huge rally. And anytime, the faster you go up, usually quick, you normally have some pretty quick pullbacks. We saw that on the S&P 500. And I did miss by, I think, 2 days because this was the low I thought was in on a closing basis. And then I thought this was the intraday low where we did actually go back down and scare the heck out of everybody with one more day. I think it may have been the next day. And if I pull this up, I think we can probably take a look at it. Now, let's go back and add some time on here. Okay, so here was the low, and this was that low I was just talking about. It was actually 2 or 3 days later. And you can see how scary when the market's selling off and the volatility index is going through the roof, how scary it can be to try to time a bottom. Because even there, I mean, I thought it was a pretty good call on February 7th, but missing it by just 1 or 2 days, you can see what the impact can be on the S&P. And trying to hold through this sell-off is not easy. But we did eventually set the bottom here. So we had a high, we had the bottom in, and now we've been consolidating. We've made this huge move up. And today, earlier, we got up to 28.73. I'm pretty sure that closing high was at 28.72 and change. So we have now tested it. And if we fail and you see weakness coming in this afternoon, that could be a short-term top on the S&P for a little bit of time. And so that's why I was saying earlier, I think we could consolidate. But the reason I mentioned that is as we were pulling back, I'm going to go back into this article. I think it may have been in here, or maybe one other. Oh, here it was. Okay, so as the S&P 500 was moving higher, I like to look at these different key areas of the market, the aggressive sectors, to see what's going on. And even though you can see that the S&P 500 took this huge tumble, notice that the technology group on a relative basis was not really getting hit hard. And if you're thinking about a market top, where the market's going to be going down for a while, these aggressive companies within technology, consumer discretionary, and some of these other areas is where you would think that there'd be a lot of selling, because those are the riskier assets. And if we're truly going into a bear market, these are the ones should be getting hit hard. Yet technology remained in its uptrend on a relative basis. We did pull back on the industrials for sure, but the overall uptrend remained in play on industrials. Consumer discretionary was going through the roof as we were pulling back. That's normally not a sign of a bear market. If you just think about GDP, what comprises GDP, consumer spending is roughly 2/3 of GDP. So if we're going into a bear market, if the market's looking out and sees trouble on the horizon, you should not be seeing consumer discretionary doing this relative to the S&P 500. And then you've got financials, which on a relative basis also performing very well. So when you look at this and you see this huge drop on the S&P, but the relative strength still holding up in the market, that's why I was looking for a bottom. And many times you can find that. I think I may have a chart of the VIX. Actually, it's not on this one. I think it's the next chart. Yeah, this was I think 2 days before that bottom call, or actually 1 day before. It was February 6th, where I wanted to look to see, look to the VIX to try to help with a bottom. The huge selling, this is an intraday chart on the Dow Jones, and this was back on February 5th, and you probably can recall this, where we lost about 1,200 points in a little more than an hour on the Dow. Rebounded, and then we started selling off again into the close. And if you look at the volatility index shot up from 21 to 35.5 in that 1 hour period. So when you get a rising VIX, what this should tell you is it might be time to go play golf or go play tennis or maybe go sightseeing or just get away from the market for a little bit, hopefully in cash, because the market can drop pretty quickly. But volatility, if you take a look at a longer term chart, and this is the S&P 500, this is a monthly chart going back all the way to 1998. So this was a 20-year monthly chart. Take a look at what happens to the S&P 500 when the VIX moves up into the 40s. You can take a look back in 1998. We were in a bull market, by the way. The S&P was up near 1,200, and literally within just a couple of months, we went from 1,200 all the way back down to 900 and change, probably 9.25, when the VIX got up into the 40s. And if you look at major bottoms during the bear market of 2000 to 2002, major short-term bottoms in the bear market occurred with VIX readings up in the 40s. And of course, 2008 was kind of an animal of its own with the financial crisis. We saw VIX go all the way up to 90, which was just unprecedented. But since then, while we've been in this bull market, look at the bottoms that come into the market when we get these huge, I didn't even mark this one here, but every time we get into the 40s in VIX, that's kind of telling us that everyone's throwing the kitchen sink in. They just can't take it anymore. And usually that marks pretty significant bottoms. So this is why I had highlighted back on February 5th or 6th, this 40 to 50 range, seeing if we could hit this. Now, if we pull up this chart and click on the live version, you will see that at the bottom, look where we went. We ended up going up and getting into that 40-50 range, and that marked the bottom on the S&P 500. So we had a lot of panic, but money was still rotating into solid areas, what I would consider solid areas of the market, or at least aggressive areas, the areas of the market that I want to follow. So let's go back over to the chart where I've got these different groups, and let's take a look at this one now. And I'm going to go back maybe maybe 2 years. Actually, let's go back. Let's get a big picture view. Let's go back 10 years and take a look at this entire bull market. That's a daily chart, so don't worry so much about what happened on individual days. Take a look at what's been happening overall. Here's the S&P 500 moving higher, and take a look at the technology group relative to the S&P 500. How much weakness are you seeing here? Because I'm not really seeing any. Yes, we've pulled back a little bit, but pullbacks are okay. I actually think we could use a little bit more of a pullback, to be honest. This is a pretty steady move higher for the past couple of years. So I wouldn't be overly concerned even if technology were to pull back a little bit. Now, industrials, while they have struggled in 2017, I could annotate this, 2018, I could annotate this chart. Look at all these relative tops that we had just above 0.0260. And look where we went down to on a relative basis. We hit relative support, and now we're seeing money rotate back in to the industrials since that low that we saw just recently. You look at the consumer discretionary, what's not to like here? Yes, we have pulled back a little bit, but my gosh, money rotated and consumer discretionary, retail stocks and so forth exploded to the upside. We have to give them a little bit of room to the downside at least. And then finally, financials. Financials broke out above that reaction high in 2009. It took a while, but we broke out in early 2017, and we continue to put in these higher lows, higher highs. I still see an uptrending financial group relative to the S&P 500. So when I look at the market, yes, industrials getting hit, although when you see small caps breaking out, and I could even take this a step further, let's take a look at the PSCI, which is the small cap industrials ETF, breaking out to a new high today. So yes, industrials, they've struggled, and I can show you the PSCI relative to the XLI, and I like to use solid charts. And let's go back on the last year and 6 months. Okay, you can see that the PSCI relative to the industrials, remember the bottom of the dollar back in February and March where the dollar started rising? Look at how the small cap industrials have been outperforming large cap industrials. So it's not that the industrials necessarily are weak, it's that the rising dollar has weakened some of the large cap components. Same with the financials, really across the board. Many of these small cap ETFs are doing much better than their large cap counterparts. Let's pull up the PSCF, for instance, relative to the XLF. So again, this is going to be small cap financials versus large cap financials. Huge move up from February, March lows. We've pulled back, and it looks like we're trying to make another breakout here on the PSCF relative to the XLF. And that's, I think, makes sense given the fact that we've just seen the dollar breakout. I wouldn't be surprised to see some movement back to the upside in this relative chart. But it's not even just the aggressive areas. We could pull up the PSCH, which is the healthcare, small cap healthcare. XLV just broke out on its own, but take a look at the PSCH relative to the XLV. Again, huge move up in small cap healthcare versus the XLV, which is the larger cap look at healthcare. But if you look at it in an absolute chart, you can see the XLV breaking out. XLV looks good. It just doesn't look as good as the small cap healthcare area. So we took a look at individual relationships, these various ETFs relative to the S&P 500. Let me just take a look at the absolute charts on, and we'll start with the XLK, which is the technology ETF. And I'm going to do, let's do maybe 3 years. And let's stretch it out to a weekly chart. So you can kind of get a feel for what's going on here. The technology group, even though we might say, okay, it needs a pause on a relative basis, on an absolute basis, it just continues to break out. And while we do technically, I guess, still have a negative divergence, I think this sideways consolidation where the PPO fell back below 2 may have done the trick, because as we move up and set new highs, I'm now seeing the PPO on the rise on the XLK. Here was a negative divergence here, higher price, lower PPO. We pulled back, and now we're moving higher. So I think the XLK is starting to improve. The XLY on an absolute basis, we saw a breakout. We saw a test of support of the breakout, and now we're moving to new highs. And again, off of the recent consolidation here, you can see that the PPO is much higher than we were just a couple of months ago. So I see momentum beginning to build in some of these areas. The XLI and the XLF, these are the areas that have struggled. But when you look at the absolute chart on the XLI, we broke out above 72.5, came back down, and we've kind of established a 70 to 72.5 area as key support. And now we're breaking out to multi-month highs on the XLI. So yes, on a relative basis, it doesn't look that great to the S&P 500, but we're starting to see money rotate into the industrials. And I think that that is a good sign short term. And then the financials, same thing. We just got ahead of ourselves. Financials and industrials led the rally going into January. And so this is a group where we've seen some consolidation. Both weekly PPOs have gone back to 0, maybe just below. And now we're starting to strengthen again. So just a quick summary, when you look at everything on the market, when we take a look at those key indices or key sectors, XLK, XLY, XLF, and XLI, everything still seems, in my opinion, to be looking up. And so it's hard, other than to maybe favor the small caps, which I think should do well with the dollar rising, I'm still bullish across the entire market. And I think even the S&P hitting resistance could set up maybe a pullback, but I don't view that pullback bearishly. I just view it as something that might be necessary to finish the sideways consolidation that we started.
Sure. I have to agree with you. That's really a great look at those sectors. And, you know, one of the things you'll notice too sometimes when we do go through sort of those corrective moves, that for a while, the more defensive sectors will do better. And you can kind of see that as a characteristic of that move. But ultimately, as you were showing, if you're not getting that kind of weakness in the aggressive ones, then, you know, that's telling you something.
Yep. And I know Greg had taken a look at the international markets, international ETFs and so forth yesterday. I talked about it earlier, and we have a poll that's running. Just wanted to kind of get a feel for what everyone thought in terms of their international investing. You know, do you invest internationally? There was a great question in the room asking whether or not we consider Canada to be international. Well, from a U.S. perspective, it is international investing in Canada, but I would say this, we didn't include it here because we do have a lot of viewers who regularly trade in Canada. So I really wanted to see around the world. We probably could have put Hong Kong in here maybe, but I think we covered most of the major markets. It seems pretty obvious to me that half of you that responded are saying you do not invest internationally. And I don't know if that's always or just now because the S&P and US markets are outperforming, but I think that that's probably been a good move, certainly in 2018 with the S&P outperforming. But about a quarter of you do invest in the emerging markets. And I would just issue one word of caution that, and I think also Greg may have touched on this yesterday, but when you're investing in these emerging markets, when the dollar's on the rise, that rising dollar will negatively impact the emerging markets ETF, that EEM, very similar to what I showed earlier with the DAX and the EWG.
Yes, absolutely.
Do you invest internationally, Erin? I do not.
No, if I do, it's really those international ETFs. And, when I look at them, I'm looking at them pretty much strictly through my technical goggles. So I'm looking at what's happening on the chart. I'm not necessarily getting too wrapped up in, the politics and all of that. I sat down when we were on the cruise with Greg Morris, and he just kept explaining the same thing. It's all baked into the chart. It's in the chart. So I do I will go into that area, but if it shows up on a scan, but I don't go out specifically to have a part of my portfolio internationally invested.
Okay. Well, I can say that, as you mentioned with the last market update, still having a pretty good day here with the Dow up 120 points, NASDAQ up 70, getting close to 7,900. The S&P has backed off a little bit, that high that we saw back in January, 2872 and change, but it still does remain up about 0.5%, up 15 points, 2871 and change. And then you got the Russell 2000, which is really flying today, up 1.3%, up 22 points, sitting at 1721.
Yes. All right, and there you go, their upcoming schedule. Tomorrow it's just you and me. Thursday we got Bill.
Well, I think we'll probably have plenty of segments to take a look at. It's been a while since we've been doing the Market Watchers live shows, so I'm sure we'll have plenty to talk about tomorrow, without a doubt.
Oh, absolutely, as always. And then Julius, yeah, he'll be coming in for you since you're going to be doing the wedding thing.
Yes, my daughter gets married a week from Saturday. Looking forward to that. First child being married off. It's a very exciting upcoming week.
Yes.
Sure. Okay, I want to thank everybody for being with us today. Please remember to complete that survey as you exit. It's been a while since we've been on here. We'd love to hear what you thought of today's show. And we always want to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and hopefully we'll see you right back here on Wednesday. Happy trading.
Here's how to put a simple line on your chart without using the annotation tool. Let's say we want a line in here at 47.50. You can just drop down here into the overlays, pick horizontal line, add the price point, 47.5, and we're going to use a red line. We're going to make it solid and thick and hit update, and that blasts it into the middle of your chart.